Welcome to the Citi Wealth Insights Market Update. My name is San Loy, Portfolio Counselor for the Citi Private Client segment. With me today is Florence Tan, Head of Advisory, who will share her insights with us. Just over a week ago, the US markets declined, falling the most in almost 2 years, and this continued into the European markets and the Asian markets. Is this the start of a correction or a more protracted bear market? We saw, Florence, US markets, the European markets, the Asian markets drop almost 10%, if not more. We saw US 10 years rally 40 points to 4-year highs in yields. What caused this, and should we be concerned?
Well, San, the US market peaked on the 26th of January. But I think we saw the sell down accelerated after we received the stronger than expected US wage reading on the 2nd of February. So the wage reading from the wage growth number from the US came in much stronger than expected, up 2.9% compared to a year ago. And that raised inflation concerns among investors, which then led to the market correction. But at the same time, what happened was that the rise in volatility then upset some of these strategies in the markets that had bet on low volatility continuing. And the unwinding of those strategies then accelerated the sell-off. And so we saw the S&P 500 decline very sharply in a very short period of time.
So, but bringing this back to inflation, which has been, I think, one of the core concerns, I think, in your research and Citi's research this year, to what extent are we seeing this rise in terms of the risk scale?
Right. So while Citi is not saying there's no inflation or growth, or there is not going to be wage growth, clearly the unemployment rate in the US is low. But at the same time, they are saying that wages will pick up, but it will be manageable. While the unemployment rate is pushing wages up, at the same time, we have structural factors such as an aging demographics. We have women coming into the workforce. We have this disruption brought about by technology that is weighing down on wages. So we do think that while yes, there will be wage growth, it will be tempered. At the same time, what we have noticed is that even if there is wage growth, companies do not tend to pass on that wage increase to the final prices of goods and services. What they tend to do is to compress their margins, and perhaps that is the concern that is that investors are worried about, margin compression. Now, for Citi analysts, we are not ignorant of that risk, and we acknowledge that risk, which is why in the bear market checklist, Citi's bear market checklist, which is an 18-factor model that looks at the warning signals in markets that warn investors of sustained bear market corrections, we have highlighted that as a potential risk for the US market.
Actually, when we look at the bear market checklist, in terms of how well it's predicted previous slowdowns, how has it performed?
So right now, that bear market checklist, there are 3.5 signals that's flashing red out of 18. Previously, at the start of the bear market correction in 2000, we had 17.5 signals flashing red. And at the start of the bear market correction in 2007, we had 13 factors flashing red.
And so now, if we're looking in terms of where the market is now, 10% down in general, we're looking still at what is a very positive growth outlook. Where do you see the opportunities realigned going forward?
Well, so one of the reasons why Citi analysts was positive equities at the start of the year and remain positive on equities now is that we do think that the global economy remains strong, and that is going to support earnings. And every factor that we are monitoring now, looking at purchasing managers index, looking at leading economic indicators, suggests that the global economy is strong and earnings growth remains healthy. So while the correction, I think, is a great reminder for investors that there's volatility out there, and we do think that actually volatility is likely to continue in the coming weeks and months, it is always important to keep portfolios diversified. And for investors who are looking for opportunities to rebalance their portfolios in this current period of volatility, Citi analysts continue to like emerging market equities. Valuations are cheap. They are trading at a discount of 34% to the US market, and we do think that earnings growth will remain strong. It's mentioned that we are positive on the global economy, and one of the reasons why we are positive on the global economy is that we do think that this year we will see a return in global investment spending, and that historically is positive for exports, which then tends to be positive for emerging markets.
And how about emerging market debt?
We are likewise positive on emerging market debt, where we do think that given our bearish view of the dollar, we do think there's upside for local currencies. At the same time, the yields of emerging market debt looks attractive.
So for the longest time now, there's been the very simple relationship where the dollar's misfortune has meant that emerging markets have done successfully well. So we have seen the dollar decline in the last year quite alarmingly. So with the slight resilience in the dollar recently, are we starting to see a turn in terms of emerging market fortunes, or is the trend going to continue for both emerging markets and the dollar?
Right. It's interesting, San, just now you mentioned about the resilience of the dollar, and yet at the same time, what we notice is that the dollar hasn't rebounded as strongly as we would expect in such a volatile period, given its historical status as a safe haven asset. And Citi believes that the dollar is on a longer-term downward trend, and that's because the economies in Europe and in Japan are picking up. So that reduces the appeal of the dollar assets. At the same time, the US has just passed a 2-year budget deal, and that potentially pushes the federal budget deficit to more than $1 trillion by fiscal year 2019, which is negative for the US dollar. So we do believe there's more downside to the dollar from here, and that is going to be positive for emerging market assets.
Thank you, Florence. And so picking up on your comment on Europe, do you continue to see the fundamentals in Europe remaining resilient?
Yes, Citi analysts continue to like European equities. Valuations are cheap, trading at a 20% discount to the US market. But at the same time, we see the momentum in the Eurozone economy accelerating. And if you look at the Eurozone Purchasing Manager Index, that's coming in at a 6-year high. And it's not just the big economies like Germany that's doing well. If you drill down, you look at the PMI indicators at Italy or even Greece, all above 50, which shows an expansion in their economies. So it does suggest that the Eurozone recovery is broad-based across regions and across sectors. And so we do think that that is going to underpin earnings.
Thank you, Florence. So in summary, we've seen inflation come back to haunt markets, and we've seen a healthy correction across many, many markets. Despite that, fundamentals are good. We'll continue to see a global synchronized recovery, but we're concerned about volatility and that it is part of the normalization process. And so it's important for investors to maintain a diversified portfolio. Yet we continue to see opportunities across Europe and across emerging markets in both equities and debt. Thank you, Florence, for your insights today. For more information, please contact your relationship manager. And for more market updates, please stay tuned to Citi Wealth Insights.